from here, the peak in 2000, it was to the next peak, which was the beginning of the crash of 2007, 2008. That's 7 years. But of course, then we had the next big crash, and it was another 6 years before we got back to that same level. So from here to there to there, that's 13 years. That goes from August 2000 to February 2013, that there was no net growth in the market. So when you think about how sophisticated you are and how you're going to time the market and all those great ideas, remember, you really don't know exactly what's going to happen. You're much better off investing systematically over long periods of time. And for those who ask, what is a long period of time? Well, here we have, now this is one of the worst periods ever, not the worst. The worst was 1929 to 1954, but that seems long ago. But this one was recent, and it was 13 years of no net growth. So keep that in mind in all your deliberations. Investing is not as much about taking advantage of opportunity. The opportunity is that the market systematically goes up over long periods of time, not that things go up and down and I can take advantage of figuring out when they're going to go up and down. But rather, the opportunity is that if we invest systematically over long periods of time, we will enjoy good net gain over that long period of time. So take advantage of that. And if you're not already doing that, make a plan to do so, starting today.
Here's an addendum in November 2022, looking at what happened from 30 years ago in November 1992. If we look at the peak we reached at the end of 2021, growth over that 30-year period was 8.5% annualized. Now, if we look at growth to today, it's been 7.6%, as we've had a bit of a rough year here in 2022. What does this mean? Simply that if you stayed invested, things tend to sort out over long periods of time, especially when we're using market indexes. Now, if you want to pick and choose the timing of when this might go up or down, history has pretty much shown that that doesn't work out very well for most investors. So even though we're down 20%, and we've been down as much as 25% on the S&P 500, a well-diversified portfolio of equities, including global equities, is down about 14% for the year. Given the long history we've had, the long run we've had of the bull market, that's not unexpected. And in fact, it may well go down again. Best advice right now, keep investing, add more, systematically invest so that you're getting the effect of dollar cost averaging and enjoy the ride of good growth over a long period of time. Now, if your time horizon is less than 10 years, and hopefully it's even longer than that, then you probably shouldn't be investing in equities much. And certainly if you don't have the risk tolerance for it, well, then you're probably going to have to look at something that is much more stable. But what I will point out is that in this same period where the market has been down 20 to 25% in 2022, the corresponding portfolio of bonds and other income instruments has been down 14%. That's supposed to be providing our stability, but it just doesn't, and it hasn't. It hasn't done that well for the last 20 plus years. So stay the course in equities is the best bet for a long period of time.